Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video. Hi everyone. In this video we are going to start a new chapter called Hire Purchase System, right? This chapter Hire Purchase System is really simple, okay? If you understand the journal entries and the calculation which is required in it, then you can easily score full marks out of this chapter, okay? So first let's understand what is the meaning of hire purchase system. See, hire purchase system is a system of credit purchasing. See, if you want to buy any item, okay, car, refrigerator, furniture, anything, any machinery, okay, if you want to buy any asset, then you can purchase those assets through this system, hire purchase system. What happens is, in this system you can purchase the asset and pay the money by the way of installments, and you will immediately get the possession of the item, but you would not get the ownership. That's the main thing of this system, that you would not get the ownership of the item. After payment of all the installments, you would get the ownership of the item. That's the main thing. If you get 2 marks questions of this term hire purchase system, then you have to mention that the ownership is transferred at the last. Okay, that's the meaning of hire purchase system. Okay, now let's see the concept of hire purchase system in detail. See, in hire purchase system there are two parties. The first party is hire purchaser. Hire what? Hire purchaser. We can also call him as HP. Okay, the first party is the hire purchaser, and the second party is the hire vendor. Hire what? Hire vendor. Now see, hire purchaser is the person who purchases the item. Who purchases the item on hire purchase system, under hire purchase system. And now hire vendor is the person who sells the item under hire purchase system. Okay, now let's, for an example, this person, let's say he is buying a car. Okay, he's buying what? Car. Now this car is asset for him, asset for the hire purchaser, but the same car is a good or an item of stock for the hire vendor. So he will consider it as sales, right? He will consider it as sales because he's selling the item, right? He's not using the item, he's selling that item. But for him, for the hire purchaser, this car is an asset. Either he is a businessman or he's using it personally, it doesn't matter, but that car is an asset for him. If he is using it for business purpose, then of course he will use it, right? And the personally also the same thing. So that car would be asset for the hire purchaser and the sales for another person, right? And what happens is, he will immediately get the possession of the car. He will what? When he will sign the agreement with the hire vendor, he will immediately get the possession of the car. He will get the key in his hand, but he will not get the ownership. The possession he will get, but the ownership would not be transferred. The ownership will remain with the seller, aka the hire vendor, until and unless all the payment has been made. Now I'll tell you the payment thing. See, the thing about payment is, the payment will be made in installment basis. Maybe let's say 5 years, okay? First, second year, third year, fourth year, and fifth year. Let's say 5 installments. So after paying off all these installments, only the ownership will be transferred to the hire purchaser. Okay, so all the payment has to be paid. Okay, so when the agreement is agreed upon, so when the agreement is signed, the first thing that happens is the down payment. So down payment is the initial payment made from the hire purchaser to the hire vendor while signing the agreement. Okay, it may be of like initial amount, so it may be less, right? It may be of 20,000, 30,000. If an item costs around 10 lakh, then it will be of 1 lakh or 50,000, depends upon the agreement. All right, so what we came to know over here, that the item for one person it is an asset, and for other it is stock, right? So he will consider it as sales, and for him it is asset purchase. Okay, all right, then the payment will be done in the installments. Yeah, payment will be done in the installments, and at the beginning of the agreement a down payment will be made, and that down payment will not include any sort of interest. Okay, it will not include any sort of interest, but here in the installment there will be interest. Here there would be interest as well as the principal amount. Okay, interest includes the installment includes interest as well as the principal amount. Okay, so installment includes both of these things, and in this chapter we have to calculate first the interest and then the principal amount. All right, so this is the concept of hire purchase system. So what the terms we came to know over here, the first term we came to know over here, that is the hire purchaser, the one who purchases the asset, then the hire vendor, the one who sells the asset, and down payment, the initial payment made from the hire purchaser to hire vendor to sign the agreement, and then there is installment, which is paid every year or monthly or quarterly, depends upon the agreement, right? And the ownership, yeah, the ownership will also be transferred at the end after payment of the last installment, right? And the possession of the good will be immediately transferred, like the possession, he will get immediately, he will be in the possession of the item. Okay, so this is the concept of hire purchase system. And the one more thing, if hire purchaser fails to pay any of those installment, let's say he fails to pay the fourth installment, he has paid third installment, the first, second and third, but he has failed to pay the fourth installment because maybe he went bankrupt or something. So what happens is, when anybody goes default, right, whenever the hire purchaser goes default, what happens is that hire vendor can come immediately and take back that asset. He can immediately take back that asset. Okay, and he would not give any money to the hire purchaser. The hire purchaser will say, oh man, come on man, I have paid 3 years of installments, I have paid your principal amount as well as interest, please refund me. But the hire vendor will say, see, according to the law, according to the Indian law, I don't have to pay you a single penny because he has used that car for 3 years. See, he has used that car for 3 years. So he will say those were the rentals, those were the rent that you paid me, those were the hire charges. All right, so he will not pay a single penny to the hire purchaser. He can directly take back the car. Okay, whenever there is a default, whenever hire purchaser doesn't pay any installment. Okay, so this is the complete concept of the hire purchase system. Now let's see the journal entries. Now let's see the journal entries that are required under hire purchase system. But before going to the journal entries, let's just see the golden rules, golden traditional rules of accounting. We used to do this in 11th standard, right? See, there are 3 types of account, right? Real account, personal account, nominal account. Debit what comes in, credit what goes out. Personal account, debit the receiver, credit the giver. Nominal account, debit all expenses and losses, credit all incomes and gains, right? Simple, right? You remember this, right? Then the other rules, modern rules, if asset increases, debit, if asset decreases, credit. Simple. If liability decreases, debit, if liability increases, credit. And same with income revenue, and also same with the capital. If it decreases, debit, if it increases, credit. But expense is similar to asset. If expense increases, we debit, and if expense decreases, we credit, right? Simple rules, right? Okay, now let's keep this aside and let's get back to the journal entries. Now I told you there are 2 parties in the hire purchase system. One is the hire purchaser, one who purchases the assets on credit, under the hire purchase system, and the person who sells the item under hire purchase system, aka the hire vendor. Now let's see the first entry. See, when down payment becomes due. Now the asset is being purchased on credit under hire purchase system, but the down payment is the initial payment made while signing the agreement, right? So now down payment has become due, the liability has arisen, right? He's supposed to pay that, so due entry is there. See, now what is the due entry? See, the liability is arising, remember that. So asset account debit. Now asset is coming in, right? So asset account debit. Asset's value is increasing in the asset account. All right. So asset will be debited. Asset increases, we debit. Hire vendor account to hire vendor account. Now hire vendor. Now who is hire vendor to hire purchaser? Now think carefully. See, hire vendor is a creditor to hire purchaser, because hire purchaser is supposed to pay to hire vendor. If you buy something from anybody, right, if you buy anything from anybody, then you have to pay them, right? So those person whom you have to pay, those are what? Yours creditor, right? You have to pay them in future. So the same thing here. So the liability is arising over here. Liability is increasing. Creditor is increasing. Creditor is a liability for hire purchaser. So if liability increases, we credit that to hire vendor account. Alright, simple. Now when goods are sold under hire purchase system, now he is selling the item. Let's say he sold a car, right? So he will record a simple credit sales entry. Okay, he will record simple credit sales entry. So hire purchaser account, to whom he sold to the hire purchaser, which is his debtor, right? So hire purchaser account debit to sales. Okay, sales is revenue, right? When revenue increases, we credit that, and hire purchaser account is debited because to hire purchaser he sold. It is his debtor, right? Debtor is an asset, so when an asset increases, we debit that. So here now liability is arisen here. Okay, now let's see the next entry, that is when down payment is paid. So whenever paid word comes, immediately you have to think about cash, right? You have to think about cash. So paid means cash is going out. Simple, right? Cash is going out, so cash will be credited. That is final. Cash will be credited to cash account. Simple, to cash account, because cash is going out. Hire vendor account is debited. Now here the liability was created. Now here that liability has been fulfilled, that has been paid. Okay, then liability has decreased here, so you have to cancel that out. So here it was credited, here you would have to debit it. Okay, so hire vendor account debit to cash, because hire vendor account, because hire vendor is receiving the cash, so debit the receiver, right? Personal account rule, debit the receiver. So hire vendor account is debited to cash account. Simple. Now see here, when down payment is received, now hire vendor is receiving the cash. Now how will he record in his books of accounts? Cash is coming in, cash account debit. Or you can see through modern approach, asset is increasing, cash account debit. Cash is an asset, right? So you can see it from both the point of view, from the modern as well as the traditional. Cash is coming in, real account debit to hire purchaser. Who gave him the cash? Who gave him? Of course, hire purchaser gave him, right? So hire purchaser will be credited. Credit the giver. Personal account rule. Credit the giver. Alright. Okay. And if you want to see it through the modern approach, then see, hire purchaser is a debtor. He paid his debt of, let's say he paid 10,000 down payment. So the 10,000 debt is being paid. So now the asset is decreasing over here. But the modern approach is a little bit difficult here. I'll suggest you to go with the traditional approach. Okay, leave it. Now let's see the third entry. When the installment becomes due, see, again the liability is arising. At the end of the year, you have to, if you are hire purchaser, you have to pay the interest as well as the principal amount of the item, right? So installment includes principal as well as interest, right? So now both of them are becoming due. Installment is becoming due. So liability is again arising, same like this. Okay, so let's see the entry now. It's a combined entry. Asset account debit, value of asset is increasing because you are paying, right? Interest account debit, interest account debit. Interest account is debited because debit all expenses and losses. So interest is being paid over here, so it is an expense. Okay, interest is what? An expense. So we debit all the expenses. To whom it is paid? It is paid to the hire vendor, to hire vendor, right? Okay, so asset account debit, interest account debit to hire vendor, right? This is the due entry. All right, liability is being created over here. Again the same thing, creditor, hire vendor is creditor and the creditors is increasing, so liability increases, we credit that, right? Now here when installment becomes due, here they will only show interest over here. Okay, so hire purchaser account debit to interest account, hire purchaser account debit to interest account. Now why hire purchaser account is debited? Because again the same thing, liability is arising, the debtor is increasing, asset is increasing, so it is debited to interest account. Now for him interest is income because he is going to receive the interest, he is not going to pay, he is going to pay. So for him it is an expense, it is debited. For him it is income, revenue, for him it is revenue, income, so revenue is always credited. Simple, right? So hire purchaser account debited to interest account. All right, now let's go to the another entry. When installment is paid, when installment is paid, again I told you whenever paid term comes, that means cash is involved, so cash is going out. Paid, right? Installment is paid, so cash is going out to cash account, cash is going out. Simple, real account rule. Credit what goes out. Now hire vendor account debit. Now why it is debited? I told you, debit the receiver, personal account rule. Hire vendor account debited, here it was created, the liability was created, now here the liability is getting cancelled. Okay, hire vendor account debit. You could see the modern way the liability is getting decreased over here, that is why it is debited, but the traditional way is better, it is very simple and easy. So hire vendor account debit, debit the receiver, hire vendor account is debited. Then here when installment is received, so now he is receiving the installment, that means cash is coming in, real account, whatever comes in you debit that to hire purchaser account, cash account debit to hire purchaser account. Now why hire purchaser account is credited? Because credit the giver, he got that cash from hire purchaser, hire purchaser is the giver, personal account rule, credit the giver. All right, simple, right? Okay, let's go ahead. Now here, now you know whoever has the asset in his business, or then he has to charge the depreciation, right? Every year at the end of the year he has to charge the depreciation. So hire purchaser has the asset, hire vendor doesn't have the asset, he sold that item to hire purchaser, so only hire purchaser has the asset, so he will charge the depreciation. So what is the depreciation entry? Depreciation account debit to asset account. Why depreciation account is debited? Because depreciation is a kind of a loss, so debit all the losses and expenses, right? Nominal account rule, debit all expenses and losses, so depreciation is a loss, so it is debited. And asset account is credited. Why? Because the value of asset is falling. Depreciation means what? Fall in the value of asset, right? Decline in the value of asset due to wear and tear or many other reasons. So to asset account, asset will be credited, okay, because of the decrease in asset. But here when depreciation is charged, I've just written this, but depreciation is not charged over here, so no entry, cause no asset, there is no asset there, how can depreciation be charged, right? So no depreciation, no entry. All right, now let's move on. Now the last entry is for transfer of interest and depreciation. Now you know all these accounts, depreciation account and interest account, has to be closed by transferring their balances to the profit and loss account. So how to do that? See, very simple. Profit and loss account debit to interest account to depreciation account. So these will be credited here. so that it can be debited in the profit and loss account. All right, you remember that, right? Interest, whatever all the expenses comes on the debit side of the profit and loss account, on this side, you remember that, on the left side, all whenever we used to prepare that in 11th standard, all the interest, depreciation, all rent paid, telephone charges, all used to come on the left side of the profit and loss account. So the same thing we are doing over here, we are transferring these balances to the profit and loss account. All right, but here there was no depreciation, right? No depreciation, only interest is there. And interest, here interest was expense, but here interest is revenue, income. So that income will be debited over here, interest account debit to profit and loss account. No depreciation, right? So if no depreciation, then you can't take depreciation over here. Only interest you have to take, interest account to profit and loss, you have to transfer it to profit and loss. See, simple to remember is that here interest was credited, right? So at last you have to debit it. Okay, and here the interest was debited and the depreciation was also debited, so here you have to credit the interest and depreciation. Okay, simple, right? So this is how you record the journal entries in the books of hire purchaser and hire vendor. It's very simple. If you understand these two charts, then it is really easy for you. Okay, easy, right? Now in the next video we will solve some problems and you will understand the whole concept very clearly. Okay, thank you.